$94 billion were wiped out on the afternoon in an air-conditioned parking garage in Kuwait, causing the world's third largest market to collapse in a few hours. When OPEC cut supply, oil prices jumped from $3 a barrel to $12 within a few months. Kuwait, producing 3 million barrels daily, saw government revenue surge from $1 billion in 1972 to $7 billion by 1974. This wasn't a gradual increase, but a sudden rush, arriving faster than the country's institutions could handle, manage, or even count. By the late 1970s, Kuwait's gross national product per capita hit $18,000, the highest worldwide at that time. Every day, the government collected between $6 and $24 million from oil alone. The citizens weren't experiencing wealth for the first time. They were already comfortable but were suddenly overwhelmed by cash beyond what the existing systems could use effectively. The official Kuwait Stock Exchange listed 30 companies, banks, typical assets producing modest returns around 3 to 5% annually. With inflation at 8% and citizens earning $18,000 per capita, the stock exchange return weren't enough to preserve wealth. People understood that investing there meant losing ground despite the formal appearance of security. In 1997, the official exchange crashed without warning, losing half of its value in just 2 months. A group known as the Magnificent Nine, who had amassed wealth from oil deals earlier in the decade, decided to bypass this closed system. They started registering companies in Bahrain and the UAE, mere shell entities with no actual operations, employees, or revenue. These shells created shares that could be traded in a market starving for anything other than the slow, steady returns. For about $5,000, one could get a certificate to trade, a placeholder for money with nowhere else to go. The first trades began in the summer of 1978 inside a parking garage adjacent to an old camel market in Kuwait City's Shibla district. After the workday ended, 20 or 30 traders in white thobes gathered under fluorescent lights, carrying briefcases. They wrote prices on blackboards and exchanged handwritten agreements based on verbal honor. And there were no brokers or official records, only what traders chose to write. The government observed but chose to let this separate market operate as an outlet for risk that the official exchange couldn't bear. By 1979, the garage overflowed with 200 traders packed so tightly it was hard to move without turning sideways. At 6 each evening, a sheikh opened the session with Bismillah. Runners sprinted between buyers and sellers with handwritten notes as share prices moved 20 to 50% within a month. These gains defied earnings or any type of assets. They simply existed because money had nowhere else to flow. And each increase made the next buyer more confident that prices could only go up. Daily volume soared from $1 million to $50 million within a year. The number of shell companies that traded grew from 40 to 120, all registered abroad, with prices decided purely by a collective expectation that tomorrow's value would be higher than today's. Kuwaiti Bedouin culture treated financial promises with an honor code that tied a man's reputation directly to his checks. Bouncing a check wasn't just an illegal problem. It brought social ruin affecting families across generations. This weight was universally understood within the souk. When traders began issuing post-dated checks for 6, 9, or 12 months ahead, the market accepted those as good as cash immediately. The culture made those promises indistinguishable from actual money. This created an endless chain of leverage. A buyer issued a post-dated check for 50,000 dinars in March 1981. The seller accepted it as cash, then used that power to write a bigger check for 200,000 dinars dated June 1981. That check then became a collateral for a $1 million loan. This layering grew faster than anyone could track. By 1980, 29,000 post-dated checks worth $70 billion circulated across Kuwait. And one trader started with just 1,000 dinars but built a paper portfolio valued at $3 billion through this chain. His name was Jasim Al-Mutawa, a government passport clerk earning $3,000 a month. In 1981, he joined the Cavaliers, a trader network skilled at pushing this check-based leverage to unprecedented scales. Over 18 months, Al-Mutawa wrote 14,000 post-dated checks totaling $14 billion in paper wealth. By December 1989, 6,000 traders flooded the souk daily. Volume reached $1 billion a day, surpassing London Stock Exchange on that same day. The total market capitalization of these shell companies, registered in hotel rooms across the Gulf, hit $100 billion, ranking third globally after New York and Tokyo. Taxi drivers borrowed from relatives to join in. Housewives sold their family jewelry to buy shares. University students skipped classes to trade, and the government kept watching from a distance, trusting the honor code to hold the system together. On October 1982, Sharaf Plaza Bank in Kuwait City, a female trader arrived carrying check number 4782, drawn on Al-Mutawa's account for 500,000 dinars, about $1.7 million, dated October 15, 1982. But instead of holding it until then, she presented it early, seeking immediate cash 3 days before. The bank processed the request and found Al-Mutawa's account was overdrawn by 200 dinars, and the check bounced. Within minutes, news of the bounced check spread through the trader phone network. By 3 o'clock, the parking garage market was desperately selling into a marketplace with no buyers because everyone realized what one bounced check meant for the 14,000 others Al-Mutawa had written, and the 29,000 checks in total. Shares in Gulf Medical plunged from 850 to 400 fills. And by 6 p.m., the market had lost 60% of its value. 2 days later, with no government bailout, the trading was stopped permanently and was never resumed again. 29,000 post-dated checks totaling $94 billion unraveling in 72 hours. All collapsed because one account held negative 200 dinars instead of 400,000. The government froze all outstanding checks in September 1982. By November, after tallying the damage to banks and families, house arrests began. Over 100 arrests followed. The Cavaliers were prohibited from leaving Kuwait while investigators unraveled the web of obligations. The central bank absorbed $18 billion in bad loans. Repayments stretched over 15 years at 3% interest, and the process was still ongoing when Iraq invaded in 1990. Distributing $94 billion over roughly 1 million people meant each citizen had exposure around $90,000. Housewives who sold gold and the taxi drivers who borrowed woke up to find their paper investments suddenly worth just 10% of what they had paid. The brick phones and the runners and evening sessions, opening with Bismillah, are now cautionary tale of what happens when social trust is mistaken for a financial instrument. Only one bounce check was all it took to collapse the world's third largest market into nothingness. If you understood today's video, then be sure to like the video and subscribe to the channel. And we will see you in the next video.